Another record-breaking month ahead. Well, in September, the S&P was up over 2% as it was in 2024. Some of you may remember in 2024 that many people were worried about September and sold short early in the month before we saw a rip-roaring rally into the close as stocks continued for the next few months. Of course, at the end of the month, I look at the monthly technical studies to get an idea of what's likely ahead. This table shows you what the performance has been in September going back to 2000. You can see it's pretty dismal, 2.46 in 24. As I said, about a little less than that in 25, but not too many great years, and the average is for a decline of 1.61%. You always got to look at, in my view, those kind of numbers based on some of the technical studies like the AD line. If we go to November, you can see it's up almost up 2%, 18 up years, 7 down years. So that's does look pretty good going into November. But will they be right? Let's take a look at the markets. The monthly chart of the SPY still looks pretty solid. You can see we got up to the yearly R2 at just about got there. 591. 65 was the R2. I've been talking about this level since way back in April, and the high this week was 689.70. Pretty dramatic move. You can see we've been up 6 months in a row. That's about the first time that's happened, I think, since 2021. Below we have the advanced decline line based on the S&P 500. You can see the major breakout we've talked about in the past. In 2023, it actually had turned positive here at the October 22 lows. Most people had bailed out after the decline, from late 21 to 22. OBV still making a new high. AD line made a marginal new high last month, just down slightly from where it was. It was a mixed close for the NYSE composite. It was down. Most of the other major averages were higher, led by the Qs, of course. And you can see, the volume was pretty heavy. It was the heaviest we've seen, for all this year, frankly. And you can see that the all AD line also made a new high, in September. It's flattened out a little bit. The stocks only, has been weaker. It clearly peaked last month, declining. So, it's still way above support levels, at the peak here, and the April lows, the major and the moving average. So, as I discussed in the article, the monthly charts and the major trend does look good. That's the good news. From the article, you can see that, so looking at the Qs in the monthly chart, another new high, up 4.8%, looking quite strong. It moved above the upper trading channel here and exceeded the yearly R2 resistance. The high last week was at 637 and a penny, and the R2 resistance was 623.76. These levels also talked about, back in earlier in the year. You can see we had a sharply higher close, that kicked off the rally. AD line on a monthly basis made a new high, still well above its rising moving average. Relative performance, a key indicator for us. If you aren't familiar, you should start to understand it. It doesn't tell you what about a market is going up or down. It just tells you how, in this case, the QQQ is doing versus the S&P. So, since really in early 23, look back in the press, no one was expecting tech to do well after the slide in 22, but the RS analysis said yes, and it's been our favorite. You can see right in April it pulled back to its moving average, now making further new highs. So, on the good status, the monthly charts show no problems. Do forecast higher prices and no signs yet of a bear market. If you want to read this article, you can search for it under Forbes: Tom Aspray. It'll come up, and I'll send you also a link in the description of the video. Of course, as we look at the shorter time frames, there are some more signs that suggest that it won't be clear sailing in November. You can see here the weekly chart of the Q shows it spiked well above this R2, but then closed off the high. So that's typically on a 1 week pattern. That's not what you'd see. You could easily see a pullback here, into the 610, 600 area. The weekly AD line made a new high a week ago, turned down slightly this week. You can see the major breakout, that completed the correction, in late April. Everyone was pretty much cleared out of their longs at this drop, which, as often is the case, just held at good support. Weekly RS, we just showed the monthly, it's very strong. Weekly is also very strong, so it's making a new high. Looking at the daily chart of the Qs, you can see, we hit the monthly, R2 with the high, in Wednesday's session of 637.01. AD line, no divergences, still positive, turned up, as did the daily RS. However, there were some worrisome signs, particularly the way some of the tech stocks act after earnings, and therefore we closed out our profits in Apple on the open Friday. We've been in since 209.49, and I guess it was about 28% profit there. No real signs of a top in Apple yet. We just, at times we get an open profit of that, and just a few months we take it. So, what were the concerns? High-low analysis. We have a more pronounced divergence now, of lower highs in October. It's up near the Stark bands, and also we see a little pick up in the NASDAQ new lows. Suggesting that though it hasn't broken out above that August peak, it's looking a little more likely that it will. We can see that through another chart. Well, first of all, through the NYSE composite, you also see the daily divergence there. Also, we got up close to 100 in the number of new lows, so that's not a good sign. Of course, you can look at the data in many different ways. This is the new highs for the SPX, SP 500. You can see, so, we got the daily divergence from last week's high, and more concerning here, as you can see, we got the increase in the new lows that was the strongest increase since way back in April when the market was getting hit pretty good. So if we look at a little longer term time frame of this, say the last 2.5 years, we can see what happens. You can see that, before that decline, in 25, you can see we started to see an increase here in March in the number of new lows before we got a big spike here. Also in 23, if we look back into 21, then you can see what happened in late 21. You start to see an increase. Early 22, that was really the tell here, is that, okay, the bears have taken over for that point of time. That looks like that's closer. You can also see last week we had a strong buy the week before, but look at the last week here. We had one day, that was, 30% of the S&P stocks were higher. Even worse in the S&P 1500, small mid caps. As I noted in the report to clients, I'm particularly more concerned again about the weakness in the small cap. We don't have a position, but if you do, I'd watch it closely. And then, of course, we have, even the Qs, down to 40% negative. On Friday, it was just 16%. If you look at the daily charts of the AD line here, you can see that the pivot here is 573, the 50-day moving average 661.89, so about 20 points below where we closed. I think that's could easily be tested in the next couple of weeks. AD line did break out, so the S&P AD line is leading again. Well, it's leading the New York certainly, not the QQQs. And you can see here that no new high in the stocks only. It's below its moving average, as is the NYSE, just slightly. So a positive open on Monday can't be ruled out, and so we could move higher early in the week. I think it'll be the weekly close, however. That's the most important. No real signs of concern yet from the VIX or the VXN. You can see they're edging higher. The VXN did close slightly above its moving average, but not the VIX yet. But it's within a dime or so of doing that. So we'll be watching that next week, and certainly we, in addition to Apple, we lightened up some other positions. So we'll be watching it next week closely to be certainly getting more defensive. Looking at the sector report, not a lot of good RS patterns here. You can see energy in particular. I published another article on Forbes. You can also find it by that search I gave you earlier, showing that while the daily is slightly positive, the monthly still looks very negative, as it has since last April. And for the most part, we pretty much avoided the energy ETFs. We couldn't stand being out of the fire the entire year, so we took a position that was quickly thrown back in our face to realize, nope, still not time. And you can see this pattern of the RS. It's not. We want market leaders. We want stocks that are leading the S&P, not lagging. Lagging here, energy, materials, industrials, though we did get back in the industrials, and we do like it better technically. Consumer discretionary, closed very weak. You can see Amazon, great earnings, so that's the exception. Booking, Tesla, is it going to go red up in here, or is it going to turn the DTS and the 4 DTS green? Time will tell. Staples, we thought we saw signs, that it was going to bottom in here, so we took a small hit on the XLP. Healthcare we still like, even though, it's dropped back below its moving average. Most of the components, do look pretty good. We have, United Healthcare, Amgen, strong, ABBV, and Lilly, green across the board. Merck just has a 4-hour DTA, and Bristol Myers, just went daily, 3-day daily, and then closed above the pivot. Healthy signs. Financials at 50, but you can see the RS does not look great. The only one that really looks strong, frankly, is the technology. Another new high, and we're in XLK, XLC, etc., and of course the QQQs. So we're holding on to a position. Our typical thing is we'll look for weekly pivot resistance levels to do some scaling out of the other positions. We just think the risk going into November is a bit high. We've been playing this one pretty well since the April-May lows, and now time is to take some money off the board. Communications exits, we're still partially long that. We took some profits last week in XLC, same sort of issue. Utilities had a rough week here. You can see now it's just neutral at 50%. Still some strong charts in here, and so we're still, we moved the stop up a little bit in the XLU with double-digit gain here. We want to try to protect that. And then lastly, real estate, also got hammered. You can see it's just above its moving average here. So, we were looking for a higher high. I mean, this is basically a bit higher, but didn't put any position on, and probably a good idea. If you look at the ETF report, you can see that there were sell signals. One of the health ETFs, also in real estate, as in USMB, that's the minimum momentum stocks. VNQ, REITs, as is XLRE. Only Brazil and transportations gave new positive weekly signals. If we scale down here, you can see 71% of the ETFs are above their quarterly pivot. Sort of a mix, but 80% positive on the quarterly pivot, 70% weekly positive signals, but only 40% on a daily. You can see ITB home builders tried to bounce last week, but no luck. IPOs also still negative, as is FDN. FGT, that's the Vanguard equivalent to XLK, is hanging in there pretty good, as is XLK. If you look at the value, 45.5, it's acting considerably weaker, in line with that ratio we talk about. So, and 30% have daily. And then if we go into the short ETFs, the only one that looks a little positive, TZA. Okay, so, and that's confirmed by, if the inverse ETF leveraged, on the small caps is positive, it should be negative on the leveraged long, which is the case. Well, that's about all I have today. Hope you had a good week of trading, and next week we could see some more significant signals, or we could continue to power higher. Just realize that investing successfully is a risk-reward ratio, and that we found the risk back in April and May to be very positive, just simply because over 40% of the investors were bearish. Now, not so much. 10% are more. 10% more are bullish. Send me your comments and questions. Tom@viperreport.com. Thank you.